Good man. All right, guys, ready to begin? Meeting order, do roll call.
Nick Curry,
Here.
Dan Jansen,
Here.
Christine Hoffman,
Here.
Brandon Maresma,
Here.
Jennifer Rutello,
Here.
David Cohill,
Present.
John Patrich,
Here.
Matthew Grocki,
Here.
John Costello, Jason Sharp,
Here.
George Camden,
Here.
Ed Dawson,
Here.
John McDaniel,
Here.
Lance Hewish,
Here.
Debbie White.
Here.
All right, Dustin, you said we can skip over.
They already did oath of office for Jennifer and,
Okay,
For
we're
John.
gonna approve some minutes. This is the general board, the special pension board meeting held on September 27th, 2024. So moved.
Second.
Do roll call or just voice?
You can do just voice.
Okay, all in favor?
Aye.
Opposed? Okay. And then the special pension board meeting held on October 31st, 2024.
Second.
All in favor?
Aye.
Passed. Consideration of general. Okay, quarterly pension board meeting held, all right, so I need a first for approving this.
so the,
Second?
Second.
Okay, all in favor?
Aye.
Any opposed? Okay. Sugarman, Suskin, Braswell, and Herrera, adding board to today. So Pedro's on the phone. Dustin,
I am sadly one of the additions. I apologize.
congratulations.
or condolences, right? Depends on what the perspective is. So good afternoon, everyone. Hope everyone's doing well. So I just have a couple things to go over with you. None necessarily actionable, but obviously, if you have any questions or anything like that, please feel free to jump in. I'm not certain if you've had a chance to take a look at the special report that we prepared, included as part of your agenda packet. No worries if not. But just if you get a chance and you want to maybe put yourself to sleep, you can take a look at it tonight. But essentially, the Florida Legislature amended two statutes last legislative session with changes that became effective as of July 1 of 24, and in some instances July 1st of next summer, 2025. But the changes really pertain to governmental agencies here in the state of Florida, certain requirements that now are needed if any new contract or is either entered into or extended. And so I think operationally, not really going to have an impact just based on the types of relationships or engagements that the pension funds have at the institutional level. Don't really, I think, lend themselves to abutting with these kinds of amendments, but nonetheless will comply with it and will be fine administratively. So the First Amendment really is to a statute 287, and it's four countries of concern. So the state has identified specific countries that it regards as, not to be redundant, concerning, I guess to be polite, and I would say it's the usual suspects that you would think of when these kinds of lists are developed. So it's China, it's Russia, it's North Korea, Iran, Syria, Cuba, and Venezuela. So if a governmental agency is entering into a contract and the counterparty needs to attest or verify that it is not a quote-unquote company of concern. And a company of concern is essentially one that's either domiciled in, operated by, or owned by, right, one of these aforementioned countries of concern. So we drafted an affidavit, and we will be circulating those to all of your service providers. So our firm obviously included, and we'll all sign off or attest to the fact that we're not a quote-unquote company of concern. And then obviously As currently we have, if you guys recall, a few years ago, there was a public entity crime bill that was enacted or passed. And now, vendors to government agencies have to attest to certain conditions that they haven't been violated or convicted of certain crimes or public entity issues. So similarly, this is just an additional kind of hoop to jump through for governmental agencies. But again, I think practically speaking, luckily it won't really have much of an impact. And so I wanted to also emphasize that this does not pertain to your investments. Your investments are, job loss regulation, are governed by another set of laws. And if you guys recall, it's the Protecting Florida's Investments Act. And so this amendment or this new law really only speaks to a direct contractual relationship, right, between the pension fund and insert party. So I just want to clarify, I know that may be something that obviously comes to mind with any kind of international or any kind of investment exposure. But so it does not apply in that vein. Okay. Any questions or anything on that? No. Okay. And then the second amendment was to similarly a statute that you don't generally hear of too often, and that's the 787, and this is the human trafficking statute. And so, obviously, in kind of continuing efforts to curb and stem human trafficking, the state now, for governmental agencies, need, again, the counterparty, right, the firm entity that's entering into the agreement with the governmental entity, or in this case, the pension fund, they need to certify and attest to the fact that they do not, quote unquote, use coercion for labor and or services. And the statute goes on to define, what exactly coercion means, and threatening a physical force, isolating or confining someone, using debt to create this indentured servitude model, right? But again, nothing I think too meaningfully impactful. We've drafted an affidavit again for all of your current providers to go ahead and sign off on, and then again, it'll be a term and condition of the contract going forward and attached as an exhibit. So we'll have all of the bases covered with respect to your contractual obligations under the state law, and hopefully it won't cause too much of an issue elsewhere. Any questions or anything on that? Nope. Okay. Excellent. So this is also, I usually take this opportunity, and since we're getting into the gift-giving season, I usually take this opportunity just to kind of refresh everyone in terms of their obligations under state ethics laws. As you guys are aware, by virtue of your service on the board, you are technically considered a public official, and so therefore subject to state ethics laws. So I know you've probably heard this before, so I apologize, but I think it's just a good practice to have it as part of our meetings, and I won't take too much time. But essentially, if you receive something of value, regardless of the value that you believe is being given to you in some way, shape, or form, to influence your decisions on the board, you should obviously reject that. If you receive something that's valued between $25 or less, you can accept it, and there's no reporting requirement. If you receive something that's valued between $25 and $100, you can similarly accept it. However, there is a reporting requirement on behalf of the giver, right? The person or the company that gives you the gift should be reporting that with the state. And then anything over $100 you should not accept, and we generally recommend filing a form with the state that's advising that you received the gift, who gave it to you, the value of the gift, and ultimately the disposition of it, right? What you did is you donated it, you returned it to sender, whatever the case may be. Okay. Hello?
Okay.
Oh, sorry. making a donation. We haven't decided yet either to, we generally just make donations either to local food banks or in light of everything that's happened in the last couple of years with the storm, hurricane relief efforts. So I think, so we haven't decided of the two which one we're doing yet, but I believe that's what we're going to be doing, and so I just wanted to let you know that we'll be doing that practice again, continuing that practice this year. But hopefully that's okay on your end. We figured those are two fairly non-controversial, apolitical charities, and so it seems to work out well for everybody.
Very good.
Perfect.
Okay, and that really concludes my my report. Unless anybody has any questions or anything you need from my end.
I'm going to consider ethically training per Pedro for this calendar year.
I think I think you can do it.
I don't think that's gonna qualify.
No?
You guys are varsity anyway, so I feel like you've been through this. You've been through this a couple times.
Okay. Thanks, Pedro.
Yes, sir, of course. And so I don't know. I was gonna sign off, but obviously I spoke to Dustin beforehand, and he said if anything came up, he can get a hold of me. I'll be available. So please feel free if you have a question. I'll be here at my desk.
Thank you.
All right, everybody. Take care. Have a great Thanksgiving tomorrow and a good holiday.
Likewise.
Take care, everybody. Bye-bye.
Bye.
Okay, so next up is Winslow and Clearbridge. Brendan, do you want to make introductions?
Yeah, well, just really quickly, we have a book with the two managers in front of you. We'll kind of use this as a reference after the presentations, but I did just want to cue that up for you, that we have kind of updated information on just those two strategies for you to kind of look at when we discuss later. So we're going to hear from Nuveen Winslow first, and then Clearbridge. And again, the idea is we have made the recommendation to move on from Allspring, our large cap growth manager. These are the two that you shortlisted last time to want to hear from. I think we had discussed kind of 20 minutes for the presentations and questions. Is that still good for the group?
Good for me.
Okay. And with that, we'll have Winslow come up and kind of go ahead and begin. And you should have the books in front of you. They're these kind of medium dark gray with a white strip along the bottom.
Good afternoon. For those who don't know me, there's a lot of familiar faces in the room from years gone by. My name is Greg Gosh with Nuveen, Vice President of Institutional Business Development. I'm joined by Barry Peters from Winslow on our senior team with Winslow. Winslow is the growth specialist of Nuveen. You're probably like, well, who's Nuveen? We are a $1.68 trillion money manager, global money manager who is owned by TIA, owns both of us. And the reason I bring up TIA is the largest retirement system not called Social Security in the Western Hemisphere. And TIA is responsible for the retirement for 5 million higher education professionals. The reason I tell you this, like, well, why is Greg going into all these different names and numbers and things like that? But the alignment of interests of what we do every day, what the Winslow team does every day, what the Nuveen investment teams, the different companies within Nuveen do on a daily basis, has very aligned interests with what you do every day for your pensioners. So when we wake up every morning, we're focused on our pensioners internally and externally. I think that makes a difference between what we do and a lot of our competitors. With that, I'm going to hand things off to Barry and kind of get into things. You said 30 minutes or 40 minutes?
appreciate any opportunity to get out of Minneapolis once the snow starts flying. And if you're not familiar with our weather, I have twin 8-year-old daughters, and I was trick-or-treating in 4 inches of fresh snow a few weeks ago, so we're officially in get me out of town season. The only way it could be more compelling is if you did it during a cold snap in January or February, but I understand why you all live here. I bet none of you own snow shovels. I'm going to introduce you to Winslow Capital. We are a boutique firm. We've been based in Minneapolis for 32 years. Large cap growth is all we do as an organization. We are maniacally focused on doing one thing, doing it well, and doing it consistently well. Clark Winslow, our founder, had a lot of rules that he ran his life by. And he's still alive and happily retired, but one of them is you can't be excellent at a lot of things. Anybody who's truly great at what they do is probably truly great at that one thing. I grew up in New England. I'm a Boston Red Sox fan. I will openly admit, so I hate any sports analogy that involves the New York Yankees. But think of it this way, right? The New York Yankees didn't create a team that won 24 world titles by having a bunch of generalists, right? Utility infielders, a bunch of people who were kind of good at a lot of different things, right? They built teams year after year with individuals who are exceptional at what they did, and then put them together as a team, and that's what's responsible, again, begrudgingly as a Red Sox fan, for those 24 world titles. Winslow Capital, we think what makes us special as an organization is like most organizations, our people are what makes us special, but what makes us unique is our investment process. And I'm going to spend the majority of my time here in the next few minutes introducing you to that. There's a little phrase that we associate with it, and it's called a no preferred habitat approach to growth investing. So that weird little 3-word phrase is what Winslow Capital is known by. But it ties back to what our goal is as a manager. And I'm going to say something that I'm willing to bet no manager has ever sat here and said to you. Our objective as an organization is not to try and be the best performing large cap growth manager in the industry. That is not what we're trying to do. Because simple logic dictates that if you're taking enough risk to be the absolute best when you're right, you're also taking enough risk to be one of the absolute worst when you're wrong. And no matter how smart you are or how long you've been doing this, eventually the market will give you a set of conditions where what you like to do maybe doesn't work so well, right? So you have to focus on, in our view, being consistent. We believe consistency of performance should be every investor's ultimate objective. So everything we do as a company is based on delivering on that goal, consistency. Right? That's why we have this maniacal focus. This is why we do one thing. It's why we don't have a small cap product, an international product, a global product, a fixed income product. We do one thing and we do it well. If you'll turn to the second page, I'm not going to use the slide presentation because more often than not, something goes wrong with the technology. So we're going to go old school this morning. I want to introduce you to our approach. In order to be consistent, you can't just, and many of you have probably seen lots of these presentations over the years, right, during your tenure here. You start with an inverted funnel, right, and in the top of the funnel goes all the things that your investment universe, all the things you could invest in. And then you go through a bunch of steps in your investment process to narrow down this broad investment universe that you could invest in to what your portfolio is. Well, our belief is really simple. If you have that type of approach so that everything that comes out of the funnel, right, that is your portfolio has all gone through the same process, those companies and their stocks are going to act similarly, perform similarly under different environments. That's not going to lead to consistent results. When you're building your portfolio, right, your retirement plans, you have different managers. You have a large cap growth manager, you have a large cap value manager, you have small cap managers, you have international managers. Why do you do that? You do it so when you blend them together, they complement one another and they give you the most consistent results with the least amount of risk possible. That's what we do. We just So what does no preferred habitat mean? It means that our portfolio is always comprised of what we believe to be three different yet complementary types of companies. By design, they're different from one another. We don't want them to all look and act and perform the same way at the same time. So you can see the three little shaded boxes. The first box or bucket, that's a sophisticated word we came up with in Minneapolis 32 years ago. The first bucket of our portfolio is consistent growth. These are companies that are very often or typically nationally, if not globally dominant, well-established business models that have withstood the test of time. They grow at a rate faster than the market as a whole, and they do so more consistently than the market as a whole. So think of companies like Microsoft in technology. Think of companies like United Health Group, a Minneapolis-based company in the healthcare sector. Think of Visa and MasterCard in the electronic payments business. They're all examples of consistent growth companies. We've owned all of them at one point in time. We own the majority of them today. We don't own Visa, we do own MasterCard. But they're kind of the foundation of our portfolio. But big, dominant, steady companies, if you just invest in them, eventually you're going to get an environment where the market likes something else. So you can't just stop there. So we then move on to dynamic growth. Dynamic growth companies, as the title would suggest, are companies that are dynamic in nature. They're growing like crazy. They're disrupting their marketplace. They're truly the greatest growth companies in the world. Think of how Amazon has changed retailing. Right? Think of how Airbnb has disrupted the hotel industry. Think of how PayPal, right, an example of the electronic payments business, has changed Visa and MasterCard's business model. Dynamic growth are the greatest growth companies in the world at or near the peak of their growth. But there's a downside to them, which is when they work, they can be wonderful. When they don't work, they can be really volatile. So I bet everyone sitting at this table is a subscriber to Netflix. Am I wrong? You're not? All right. We're batting 95%.
I'm not for that part.
Okay. Very few companies have changed their business on a global basis the way Netflix has. But when Netflix as a company reports its earnings every quarter, the whole world is focused on one thing and one thing alone, which is what? How many new subscribers did we have in the last quarter? If Netflix beats that number, the stock is great. If Netflix misses that number by that much, the stock gets hammered. Now, over the long arc of time, Netflix has done exceptionally well at meeting and exceeding those numbers. But along the path, it's been up, down, right? It's been really volatile. So our view with dynamic growth is really simple. We're a growth manager. Of course we're going to invest in the greatest growth companies in the world. But sometimes a little bit goes a long way. Sometimes, right, be careful what you ask for. Have any of you ever heard of Kathy Wood, who runs the ARC Innovation Fund? Her whole portfolio is dynamic growth. And I bet everyone wanted to be invested in it in 2020 when it was up 110+%. It's a great investment. But most people didn't buy it before that. They bought it after that because of the up 110%. What happened the very next year?
We lost half.
She was down
As I did.
close to 70%. That's a roller coaster ride. And I don't know about you, but as I get older and near retirement, I don't like roller coasters anymore, right? I don't have the stomach that I used to have at one point. So while it's always represented in our portfolio, it will never be the entire portfolio. It will always just be a piece. The last piece of the portfolio is cyclical growth. If you think of cyclical growth as we define it, it's the exact opposite of consistent growth. Instead of companies that grow above the market with greater consistency, these companies, for the most part, grow below the market with less consistency. In a fancy way of saying less consistent is cyclical. So there are certain segments of the market that are cyclical by nature, right? Energy companies are really cyclical. Financial companies are really cyclical. industry for 150 years. It's the perfect cyclical. When the economy's slowing down, shipping slows down, trucking slows down, railroads slow down. When things start to pick up, you participate in that upturn. And in Union Pacific, you own one of two railroads who basically control all shipping in North America. That's why we love their business model. So when you look at our portfolio, all day, every day, we always own all three pieces.
Each one.
We will never own just one. That's what no preferred habitat means. But in order to make this work, you have to have flexibility. Right? You have to be able to adjust and adapt to the environment in which you are living and investing in right now. We don't want to underperform ever for our clients. But I will tell you the thing we absolutely will not accept is underperforming for a prolonged period of time and coming to you and doing client meetings and saying, remember what I told you last quarter, why we underperformed for that quarter? And that's the same thing this quarter. That is totally unacceptable. You, as an investor, have to adapt to the environment in which you find yourself right now, and you have to be able to do that all the time. So with this approach, we give ourselves flexibility. We will never just be a third, a third, a third. We give ourselves the ability to lean into, as we say, and enhance or own a little bit more of any one type of these growth companies when that's what the market is favoring. So think of this very simply and think of the three different buckets of our portfolio. When you get into the great financial crisis and everybody wants to play defense, what part of our portfolio provides that? The consistent, steady edge, right? When the market likes risk, like it did in calendar year 2020, what part of the portfolio do you think is going to perform best? Dynamic growth. If the economy is slowing down, you want less cyclical exposure. If the economy is picking up, you want more cyclical exposure. So we give ourselves the flexibility to shift the mix, so to speak, to change the profile of the portfolio to adapt to the environment in which we're investing in today. Our results over time, if you go to the next page, there's two charts here. The chart on the right shows our rolling 5-year returns versus the S&P 500. That dark line is the 5-year average annual return of the S&P 500. So it starts with the worst 5-year period in the lower left-hand corner of that dark line, and then you go up into the right to the best 5-year period. Those circles that you see are our portfolio's performance on both a gross of fee and net of fee basis. So the light shaded is the gross, the dark shaded is the net. What you see is really simple. We've consistently added value and outperformed the market. We've done so in the lower left-hand corner when things are bad. We've done so in the middle when things are kind of normal. And we've done so in the upper right-hand corner, which is when the market is honestly ripping. That's the S&P 500. As a growth manager, our clients often obviously compare us to a growth index. So the Russell 1000 Growth Index is a chart on the left. And I think you can see the same types of characteristics. We add our most value when things are bad. We consistently add value when things are normal. And if the worst thing you can say about us is the upper right-hand corner, well, when the market's ripping, you haven't outperformed the market by a lot. And our argument would be, when the market's ripping, all you have to do is participate. You just simply, you should be happy to keep pace with the market. But that's not the environment where you try and take a lot more risk to maybe add that much more incremental return. I worked for many, many years with a gentleman who was from Iowa. He was a large cap growth manager. And he had an old saying. He said, in the investment world, bulls make money, bears make money, pigs eventually get slaughtered. Don't be a pig. Right? If the market's giving you 25, take 25. Don't try and take a lot of additional risk in your portfolio to get 27. the worst you can say about Winslow Capital. I'm perfectly content with that being our Achilles heel. If you'll turn to the next page, I'm going to close with our results. And then I'm going to give you something to remember. Our results, from a pure investment standpoint, on the left-hand side, it shows we rank in the 24th percentile. We're in the top quartile. Out of all the managers who do what we do, and there's more than 1,200 firms that have track records beyond 10 years in our business. So it's a very competitive landscape. To be in the top quartile are strong results. But what's more compelling is the little chart on the right, which shows the risk-adjusted return. Information ratio is a fancy statistic, but I'll tell you what it shows. It shows the consistency and predictability of your value add as a manager. If you roll the dice and you're really right one year and really wrong the next, you're going to have a horrible information ratio. If you're very consistent, and again, back to my baseball analogy, hit lots of singles, bunch of doubles, the occasional triple or a home run, you're going to have a high information ratio. Our information ratio ranks in the 8th percentile, meaning we do what we do, generating excess results more consistently than 92% of the firms who've done what we've done. And this goes back over the last 25 years. So, as our founder, Clark Winslow, used to say, I was born to do this. Just remember our name. Win slow. Win slow. Right? Deliver your results. Be consistent. Allow your plan participants to own, invest in, and maintain their ownership in these great growth companies and the results that come with it. But if you're providing them a roller coaster ride, right, like Happy Wooded Art, and you're in the top 2% when you're right, and you're in the bottom 2% when you're wrong, like most roller coaster rides for retirees, they're going to say, I'm off, right? I've had enough. And they're going to make bad investment decisions based on emotion that's really real, right? Suffering a 75% loss is really painful. I'll put it another way. Almost all the assets of our firm we manage are retirement plans. 100% of our institutional business, where organizations have $25 million account minimums and up, invest with us. Every one of them is a retirement plan. We go to work every day realizing that we run the biggest piece of every one of our clients' portfolios. So if we make a mistake, it can be critical, right? I mean, we can really destroy the financial well-being of our clients. If they are nearing retirement or in retirement, they may never recover from that. So that's why we focus on consistency. That's why we focus on the win slow approach, right? Questions?
Can you talk to us about the consistency and predictability of your management fees?
Sure. We run our strategy, and like many managers, offer it in a multitude of different vehicles that you can access. I think for your particular plan, the most attractive vehicle and fee is what's called a collective trust, the CIT, and it's at 35 basis points. It's 0.35%. We have mutual funds, obviously, that have lower minimums and aren't for organizations such as yourself, where the fees are materially higher. That CIT is actually the lowest price structure we have as an organization.
You want to go higher, we have a separate account at 60 basis points. But it's a separate account, so it's
Second, sure.
Is it?
Yep. Okay. Again, we really appreciate the opportunity to visit with you. We would be honored should you select us. And I get to come back to Jacksonville Beach. And I highly recommend you schedule all your update meetings in January or February.
or July, it's fine.
Thank you.
table. If you want to use that, you can. I know they have your book in front of them, so.
Perfect.
And they'll use it.
Yeah. Thank you. We're the overdressed ones.
We'd rather be dressed like you, but we want to try to make a good impression. Thanks for your time. Thank you to both the board and to Mariner for the opportunity to present to you today. Intros, my name is Terrence Fennessy. I'm a Director of Business Development at Clearbridge. With me is Vinay Nadkarni. Vinay is a client portfolio manager at the firm. He's got over 30 years of experience. And on this particular strategy, the large cap growth strategy, he's got 25 plus years of experience. So a host of experience to run through the strategy. I promise you, we will keep you on schedule, if not ahead of schedule. And if Brandon needs to give us the white flag at some point, that's fine, but ideally he won't have to. A quick comment on partnership. And it's kind of our firm DNA. We think partnership is critically important with our clients. Clearly, we want to partner with you, deliver exceptional investment results, and help you achieve your investment goals. But as importantly, we want to help you with your mission. Here in Florida, we've been awfully active with FPPTA. I may have met some of you at FPPTA events, and we think that's really important. So I think that combination of investment performance and supporting our clients it's a good combination. In terms of the strategy, and I'll just highlight it before I turn it over to Vinay to run through it. One, we're delivering a resilient large cap growth strategy. It has diversification. We invest in different types of growth companies. It is concentrated. We own 40 to 50 names. We've got a laser focus on risk management. So this is an all-weather portfolio. So a portfolio that should do well for you regardless of the market environment. And we think that's important because the last thing you want to do is be trading in and out of managers over the years. You'd like to hire a manager that you know and trust and deliver good long-term performance. Let me stop there. Any questions for me before Vinay focuses on the highlights of the strategy? And we want to make it interactive, so if you have questions, by all means, just raise a hand. All right? Great. It's all yours.
Thanks, everybody. In advance, happy Thanksgiving to everybody. I hope everybody has a joyous holiday season. So, on page 2, I think the value proposition that Terrence talked about, I just want to highlight what we try to offer clients. We try to strike this balance of being purposefully different, where we think we have an advantage relative to the marketplace if you open your book to page 2, while being relatively risk aware. Risk awareness to us is the type of stocks that we buy, when we buy them, how we size the positions, and how we put it all together. Think of like a great chef and how you mix those ingredients together. That's really what we're going to offer you in our solution, is somebody who thinks about being purposely different, where we're trying to separate fad from trend. We've owned some businesses in this portfolio for over 25 years continuously, and we think the advantage, much like in a pension plan, is around the compounding of that wealth, not in kind of trading around. So that's really the value proposition. What I hope to articulate in these next 10 to 15 minutes is how we're purposely different, how we're risk aware. So if you go to page 3 and kind of you have it nicely open, the team, right? If you're representing both the general employees, the fire, and the police, and we always think about a team and knowing each other's roles. So if you look at the 3-person team, in addition to the 16 research analysts that we have at the firm that support the strategy, we always say each person brings a unique skill set to bear to help us generate the strong results. So in the middle is Margaret Vitrano. I knew her when she was Margaret Blades before she was married and had kids. And so she's like our chief operating officer, the chief administrative officer that says, where are we on the agenda? What are the 3 next ideas that we're working with? How are we thinking about working with the analysts on the questions for this? So really thinking about how do we administer the strategy really well day to day. And then you have different skill sets. Peter, to me, is like a glass half full, half empty person, always thinking about the downside risk. He's the most skeptical growth manager you'll ever meet in your life. And then you have Erica Fafaro, who's like a great optimist and thinking about the imaginative, open-ended areas of growth. So really to us, the idea of each person having their role and bringing that together to generate the human capital decisions is really important. I'm going to go into the three parts that I think make us purposely different. I'm going to ask you to turn to page 6 of the presentation. And this is where I think what really differentiates us is you'll see a lot of other managers that start with what's the growth rate, what's the valuation. We start with business model first. So these three building blocks that you'll see above me, you really think about it in, is this a good industry, and is this a leading company within that industry? That's really the framework to start with. The second key pillar is to think about the financial structure. Is it a conservatively financed company? How are they going to grow? And all things being equal, we want them to finance that with their own cash flow and not have to go to the equity markets or try to raise capital through debt offerings over and over again. So very conservatively financed. And then this third pillar of management analysis, much like you're asking us to come today and present to you, it's really important to look in the eyes of the management teams that we're going to entrust our capital with, and not just have them understand when things will go well, but when things will go less well. And really thinking about that clarity of vision. Margaret has taught me over the years that if a company management team can articulate to me what their mission is, they'll be able to articulate it to every employee at the firm, and they'll be able to execute on that mission very clearly. So to me, once we've answered that question is this a good business that we could own through a cycle? Then the question is, what do we want to pay for it? And valuation is really kept for last, because we don't want to be seduced by cheap valuation or expensive valuation. We really want to start with, is this a good business that we can own for multiple years? So that's really the first way we're purposely different. We kind of flip the funnel. If you turn the page, you can see there on page 7, the next way that we're very different than our peers is, instead of saying we're going to be a high growth manager or a conservative growth manager, these three key areas, what we call a spectrum of growth, is really how we execute on saying what Terrence said before. How can we become an all-weather strategy? One of our Florida pension clients that I've had the pleasure to work with over the last decade said, instead of predicting where the market is going, we try to say, what is the market giving us and where are the opportunities at that moment in time? And so instead of saying, this is where we think earnings are going to be or the economy is going to be, let's just try to find the appropriate amount of balance between these 40 to 50 companies. So let me articulate what those three types of growth companies are. The majority of the portfolio, at least 50%, is going to be in that middle area, what I call stable names. So you see United Healthcare and Visa as the type of names that you see within that part of the portfolio. We owned United Healthcare since Obamacare was implemented in 2010. We bought Visa also in 2010 when people worried about would there be regulation of the kind of credit card companies. And now we've continuously owned those companies for 15 years. The second part of the portfolio is what we call these select names, more higher growth names, what people traditionally think of as growth names. So we own Amazon in this portfolio. We own NVIDIA in this portfolio. We own Tesla in this portfolio. But the difference is we bought Amazon in 2004 when, archaically, the thing that they were disrupting was books, Borders and Barnes & Noble, right? Now nobody, if I tell my 18-year-old daughter that there's a Barnes & Noble, she doesn't even know what that is, right? But that was the first thing that they disrupted. And the ability to take that to new areas of the market is what I did. When we bought NVIDIA, we did it in 2018 when it sold off 50%, when nobody talked about artificial intelligence. And the idea was that people were worried about the durability of gaming growth. And then with Tesla, we bought it at the end of 22, when the stock corrected after 50% after Musk took over Twitter. And so each of these type of things creates that opportunity. And that's maybe the last way we're different. Is most growth managers think about momentum. We try to buy these companies when they're down, because it gives us both the chance to participate in a long-term trend and a short-term opportunity. So that's how you should think about it. So that's about a third of the portfolio. And then the remaining part, which really is atypical for a lot of growth managers, is it's called cyclical, but I think of these as opportunistic things. So you see Union Pacific there, you see Target, which we bought last year. But to me, the two best examples that we had, we bought a company, Chipotle, in 2016 after they had their food scare issues. They brought in a new CEO. The new CEO of that company, that CEO of that company, Brian Niccol, was just named the CEO of Starbucks. And we bought Starbucks actually 3 months ago on that announcement. And the idea of taking a great brand that's a little bit undermanaged, and returning it to its prior glory. That's how you should think of this part of the portfolio, about 10 to 15% of the portfolio. So you mix these ingredients well, and hopefully you'll have an all-weather growth portfolio. I'm going to kind of close with two kind of key areas, page 9 and page 14. So page 9 to me is really important because it's important if we're fortunate enough to be selected to manage assets for your plan, that you understand when we'll do well, and like any manager, there will be periods where we don't do as well. So if you go to page 9, it has this slide of how we, oh, I'm sorry, page 10. I apologize. This is what you try to do when you memorize everything. You sometimes make mistakes. So on page 10, we've traditionally done very well in kind of moderate growth environments and especially declining markets, right? We call it kind of win by not losing. So if you look on this page, if you look at the past periods when we've been down by more than the market is corrected by more than 8%, we've outperformed in all but one of those periods, including this period in June and July of this year, where we actually created 400 basis points, 4% of excess performance for our clients. So we think because we've thought about the durability of these businesses and not so much about the valuation, we can really have that kind of anchor when the market sells off. People don't worry about that as much when the markets are up 20, 25%, but those inevitably happen, and we keep people kind of invested during those time periods. So I think setting an expectation of that's the best time for this strategy, a moderate growth environment, kind of single digit to 15% plus market returns should be really good for this strategy. Usually when the market's up more than 25%, because we cap that high growth portion of the portfolio at about a third, is when we're going to struggle. And so that, I think, sets up performance activity. If the market's up a lot, we'll probably be in line to be behind just by a little bit, but when we're really going to do well is those kind of more choppy markets. So that was one page. If you go to maybe page 14, that would be my kind of closing statement, or closing view to you is, let's look forward. And so I think where I would ask you to look is in that kind of middle part of the portfolio. So many growth managers own all the same stocks. But if you look at the middle part of the portfolio, our weighting within that kind of next generation of growth companies, which is in what they call 50 billion to 250 billion. So not the NVIDIAs, not the Amazons, that next generation of companies, we have almost twice the weight of the benchmark. So we don't look like the benchmark, and we can be different, but I think that positioning around what are the next growth companies that are going to happen. And you're starting to see this happen really since the end of June, where the market has broadened out, and that should be a real asset for our strategy. And then on the right side, if you look at the weightings in on page 14 on the left, on the right side, if you look at our position, I would challenge you to find another growth manager who has done as well as we have over the last couple of years, when we're this underweight information technology, when all the headlines in the market have been about what they call the Magnificent Seven, these kind of big cap tech stocks, and we've been able to hold our own bit. If the market broadens beyond kind of technology as an area of market leadership, we should be able to do really, really well. So, Terrence, did you have any closing comments on this?
I do, but let me pause there in case there are any questions for us.
On
Comments?
page 15, are all those S&P 500s? I don't know about Palo Alto or Salesforce.
Yeah, sure. So when you say, so now our benchmark is the Russell 1000 growth. These are large cap companies, but like Palo Alto, that's kind of that, Daniel, that's a great indication of that next generation of companies, right? So Palo Alto is a security company with everything that's happening around cybersecurity. They've had among the best products in the market, a Blade product that is a market-leading technology in cybersecurity. So that's a name that we've owned probably since 2016. And then Salesforce is a name that most people are aware of. It's kind of a web-based software, often for the enterprise or like people in the financial services or other industries of how they segment and target and service their client base. And we've owned that company now for 5-6 years. So that's the type of company. Those are both S&P 500 companies, but our weighting in the portfolio is significantly higher than that that's in the benchmark.
Yeah,
Go ahead.
I know you sit around and ask yourself this question. NVIDIA, which I love.
Yes.
You've got it at 10%, and I know three of their largest customers are endeavoring to be their competitor.
Yes.
You know that.
Oh,
But
yes, I'm well.
You're 10% of your.
Yep.
Or
So,
what's your thoughts on that?
yeah, so that's a very good observation on your part. And we've actually trimmed that position by over 300 basis points in the last 18 months because there's probably never been a company of this scale that's grown its revenues by 100% like they did in 2023.
Two of their competitors are right here, or
Yes, well,
customers.
their biggest customers, just to give everybody, are it's Amazon, it's Microsoft, and it's Google, right? Alphabet. And so all of these companies are trying to figure out, can they create their own chips? Now, our analysis around that is that while they're trying to create their own chips, it's for specific use cases, whereas NVIDIA is a platform that can be used by almost anybody. We would agree that NVIDIA right now, so this is the challenge, I think, for any growth manager, especially in large growth. You look at that position and say, oh my gosh, it's 10%. But it's actually a lower weight than is in the benchmark. If you can believe that. So we've actually, if we hadn't trimmed any of NVIDIA, we'd probably own 14, 15%. But we have actually been cognizant about the risk, and we've been putting it into other semiconductor names, look at other software names. That was where Salesforce comes into play. That's how we can.
Microsoft's trying to buy a nuclear power plant, so.
The biggest companies are truly, it's like the 1870s, right? Like they have enormous power and they're trying to understand how broad that can be. But to your point, there's going to be a point where the valuation, or they're competing against each other. What has happened over the last few years is they've all kind of done well. We believe we're in a market where only a few of them will do well. And picking which ones will do well and which ones won't will differentiate, who does well for your plan.
Union Pacific did that a long time.
Union Pacific did that, right? Like, yeah.
What are your management fees?
It's on page 20, Daniel. So we're recommending a CIT share class at 40 basis points. Another thing I would add in terms of working with us, Brandon knows this, we're highly transparent. So if we're fortunate enough to be hired and be your partner, if there are questions the board has during the quarter, what are we buying, what are we thinking, we share that information. So you should never feel like you gotta wait till the end of the quarter to get an update on what's our portfolio doing, what are we thinking. We're highly transparent with our clients, and we really encourage our clients to ask us questions, and we provide feedback. So I just want you to know we truly value those conversations, ongoing conversations we have with our clients. And should we be fortunate enough to be hired, Vinay and I would be the ones supporting this account. Anything else?
Not to say that it's likely, but if they were interested in a separate account and didn't want the CIT vehicle for some reason.
They can do that.
What would the fee be for a separate account?
Separate account.
I think we'd be fine, but if you wanted to have the same.
Yeah.
Okay. Yeah.
Your
Yeah.
preference.
I would say that that's a good point, Brandon. We've always said that our intention is to manage the strategy, the vehicle that you choose, whether that's a separate account, whether that's a CIT, whatever you choose is best for your plan, and you should let us know. And
We'll make sure it happens.
Yeah.
All right.
Any other questions from anybody on the boards?
Thank you for the letter. Okay.
You guys just come for the weather.
Yeah. Well,
we're doing this as a day trip, so the answer is no. but to have the sunshine is great.
Okay.
Yeah, thanks.
Thank you.
Thanks so much. Bye-bye.
All right. So before I jump into anything, any initial thoughts, feelings on the presentation, anything you'd like to discuss? Jump into.
Yeah, so I pulled up the requirements.
Yeah.
Book that you referenced to, and you're gonna have to help refresh my memory a little bit on this. So I'm looking at the Clearbridge and Winslow page, I'm on page.
Page 5, probably embedded down between the lines in the bottom left. Yeah, 5.
Oh, okay,
The thin one that says large cap. Page number 5, which I call it, it's hard to see, it's between the two lines of text down the bottom left hand corner.
So, and I remember we talked about this, but I
what I'll distill it down into a very simple one. The last 10 years, growth, and I'm just looking at the index right now. The last 10 years, the index is down over 16%. When you compare Winslow and Clearbridge to each other, probably heard a lot of similarities in the presentation, but there's a little bit of nuanced difference. Essentially, Winslow has, on average, a higher component of those sort of what they call dynamic names, riskier, growthier names. It's a higher percentage. So in a 10-year period where the index did 16%, they're giving you a bit more upside because they have a higher portion of those kind of riskier, growthier names, where Clearbridge on average tends to have a little less of those. So I think that again, there are a lot of similarities, but I think that's the primary difference. Just to put that into numbers, if you flip ahead to page number 10, which is essentially the last page of that short book, a lot of numbers on this page. I'm really only going to focus on 2 lines. So let's use the 10-year, which is on the bottom half of page number 10. The third line down says STD DEV, standard deviation. Okay? That's the height of the roller coaster. In percentage terms, performance, how much is it going up and down? If you had a standard deviation of 0, your performance would just be a straight line. It would never deviate, right? If you've got a standard deviation of 100, that means you have a huge upside and a huge downside. And then obviously, so the lesser that number, the more stable the ride. The lower the highs and the lower the lows. So what you'll notice is Clearbridge is at 17%, Winslow at 17.9. Not dramatically different, but a little more volatile, a little more up and down. And that also correlates to the next number immediately below that, which is beta. That's the measure of market risk. You see Clearbridge at 98, Winslow at 102. If you go up to the top half of the page, that's looking on the trailing 7-year. The numbers are slightly different, but the relationship is the same. Clearbridge has a little bit lower standard deviation, a little bit lower beta. And so again, I take it back to, in a 10-year period where you've got double-digit returns, having a little more beta, having a little more risk in the portfolio gives you a little better return. So then the question becomes on a go-forward basis. Again, I think both do well, but apple to apple, Clearbridge does probably a little bit better the more challenged the market is, and the more the market is neutral to stronger positive. Winslow probably can do a little bit better. Any other questions, thoughts on what you've heard? Again, both very good managers, like I said. Both, I think, very competitive fees. The standard fee for large cap growth is kind of between 50 and 60 basis points. So both are really at kind of the low end of that range. 35 basis points, and just so you understood, or if you don't understand, Winslow is offering a CIT, Collective Investment Trust, which is a pooled vehicle, similar to a mutual fund, but technically a little different. But that is a vehicle that can be purchased inside or at your custodial firm. So some CITs, you actually contract directly with the provider, and then you kind of send the money to them and you have an account there with them, and then if you need money back, you have it wired back to your custodial bank, sale, and trust. This particular version of the CIT, you actually have sale and trust buy it within your account. So it will reside, if you will, at sale and trust, and is held there like a mutual fund would. Just for comparison, the separate account you have with Allspring that is also at sale and trust, but that is a specific designated account that Allspring is buying and selling securities on your behalf. So when they each mention separate account, you could have that same type of relationship. With Winslow, it's more expensive, so it kind of doesn't make sense to do that. With Clearbridge, they're offering the same fee for either vehicle. So from that standpoint, you just have the flexibility to choose between the two.
With my brain speaking out loud, I like the fact that Clearbridge can do better in a more volatile market. Although there's a benefit to Winslow and their what is the likelihood or viability if we went to Clearbridge and said, sure, we like everything you have, but what about a 35 basis points, 0.35 basis versus 40? Let's make it competitive.
I can certainly ask. I will tell you that both of these firms, along with another, were involved with another similar presentation just a few weeks ago. They weren't even offering 40 at that point. Discussions since then, because the fee was such a difference, that they came back and they said we can go to 40, but and they understood that Winslow would have a fee of 35. So I can't say they won't do it, but I would guess at this point that 40 is probably the best. But again, I'm happy to ask if that's a consideration. The thing that I would throw out there, fee differences are meaningful, but when you look out over 5 or 10 years, that 5 basis point difference is pretty small relative to what we tend to see in performance difference. You know, if one does better than the other, they're going to do so by 0.5%, 0.75%, you know, far more than that 5 basis point difference in fee.
I think the perception of it being even is helpful. Well, I think it's really nice.
The fee, sure.
So I'm opposite of Dan when he said about the murky waters and they doing better. My point is like, if we're in the ability to make more money, I would rather have the ability to make more money at that time, rather than when we're looking at a downward market and it's trending downwards to lose less. So I see both points of it, but at the same time, I don't want to have a company that doesn't, and he even made a point to say they don't look forward. Looking forward, or they don't look forward, they're looking at what the market makes their money now. To me, they're not looking, it's a weird statement to say they're not looking forward to see what's going to happen with the market.
I agree with you. That's why I was trying to push Clearbridge to 35, at 35 basis points. Then maybe we're in agreement. If not, then
I said go back to Winslow, page 5, to piggyback on what Jason said.
Yeah.
If we're looking at their chart, to pick a manager because of their downside, if you draw a line over from the 0 rate of return, you pick up maybe 1/10 of the incidents where there's a negative return, and I don't think we should pick a manager based on better performance on 1/10. I'd rather be looking at the 9/10s.
And it's not in any of these books, and again, I'm not even sure if you were on the committee at the time when we selected JP Morgan for our large cap value strategy. That one is a little bit more defensive oriented. So just as a 10,000 foot thing, if we have a little more defensive position on the value side, maybe there's an argument for having a little more aggressive on the growth side, so the two complement each other, as opposed to having sort of a little more defensive on either side, because then again, if you get the sort of the higher growth or the higher running market, then both are likely to be a little bit more behind, as opposed to one being ahead and one behind. And again, I'm speaking all in relative terms, of course. Right.
Hell, they're both better than Allspring anyways.
Yeah. Fair enough.
Although interestingly, not just of late, the last couple of months, Allspring has actually done incredibly well, which is fantastic.
It's perfect for making it back wherever we sell.
Maybe. I mean, just, you won't see it, we'll get to this. It's up 9.5% since October 1st. I mean, all
That's why we waited until November to make the decision.
Exactly, yeah. That's why we kicked this
Well
can down the road.
done, well
I
done.
told you we're looking forward.
Crystal ball.
Yeah, but then again, it's less of, you know, going back to the Allspring, the recommendation, it had to do with the change in personnel, the retirement of the team, and the fact that they took essentially two different firms and kind of glued them together, sort of let go part of this team, let go part of this team, and we're trying to merge the remaining folks, and there's just going to be some, that was really the basis for the recommendation. Although performance certainly has been challenged, that was the reason, kind of instability of the team and process.
Where's Clearbridge out of?
Maryland, Baltimore.
Well, I like on page 4, Winslow does seem to be, and you know, the two companies, not surprisingly, had almost the same philosophy. But I did like the concept of, you know, firms in their portfolio, and they're shifting, you know, shares back and forth depending on when one's down, so it looks like there might be growth coming up. Just seem to go more proactive. And I think we have, well, personally, I'd rather we were more conservative over the next few years, just because, you know, the risks to the global economy are something that nobody has any idea, you know, what's going to happen. And, you know, it's not our money that we're managing, so.
It's my money. Yeah.
Yeah, technically
Careful with
it's the-
that.
Technically, it's the city's money though, isn't it?
No, I make contributions into it. So
Yeah,
if you'll
you
see
do.
these members that take money out, it is the members' money. Now, the city does make a contribution, and the city is the backer of the pension fund. However,
Exactly.
as a representative, it is the members, it is a portion of the members' money,
I appreciate that, but if we lose, the city has to make it good, correct?
100%.
Sounds like we've got a few on both sides. Some in favor of Winslow, some Clearbridge.
So the straw poll,
So this is by board, right?
Yeah, because our funds are currently held, so we would have to make the same decision. So it is by
All
board,
boards
but
have to make a thing, we all have to agree.
we all have to agree.
Back to JP Morgan.
You've got a single account with Allspring that essentially each board kind of has a representative interest in. And similarly, if you were to move, you'd have the same type of relationship.
Yeah, the only reason why I would even consider Clearbridge is if they drop their basis points, and it sounds to me like.
I mean, again, I'm happy to step out and try to call Terrence and ask the question, so if that's.
But I would say that if the majority's leaning toward Winslow, let's go with Winslow. This is both presentations, I think are fantastic. I think we're splitting hairs here for the most part.
Yeah, I
If
see.
you're doing a straw poll, I say Winslow.
You want to make a motion, we need a motion?
We'll get a discussion and talk about it, right?
Yeah, we- yeah.
You can give there and then give a motion, right?
We can do a motion, a second, and then
Yeah.
discussion.
Right.
Or just discuss? I would need a motion from each board.
From each board?
Yeah. I'll kick it off. I make a motion for the police board to sell, liquidate,
Terminate the Allspring portfolio.
That's a strong word. I like it. Terminate the Allspring portfolio and hire, brain fart.
You're doing this.
Winslow, sorry. Second.
I like that brain fart made it into the
Well, this is general place.
I prefer brain fart.
and I move that we terminate Allspring and, invest it in Winslow.
Second.
Officially discuss.
And I'll say that I think like Dan, I'd go with either one if there's strong feelings among others of you. The fact that I, you know, was in favor of Winslow is, it's a very, very marginal thing.
Yeah, the only way I'm going with Clearbridge is if they're dropping their management fees. So let's just move towards Winslow. They had the. I think.
I heard you asked about a second account, and maybe 20 minutes in, I'm not sure. What would be the reason for the separate account?
Additional customization, so in a collective vehicle, you are one investor among many, and well, not just as the plan, but your assets would be commingled with 20, 30, 40 other pension plans and other investors.
Oh, I thought you were indicating three here.
No, so they have essentially a master, like a agreement or a binder that how they have to manage that account. Now, the way they do that is the same process and strategy as if you hired them in a separate account, and they would effectively mirror each other with the caveat that in a separate account and a direct contract that you have with the manager, you have the ability via your IPS to just, and I'm gonna make something up, where we do not want you to buy ExxonMobil for whatever reason, and in a separate account, you could prohibit certain individual things, where in a commingled vehicle, they have to treat you the same as everyone else, so they can't make those specific provisions or
I was wondering if it was that normal, or if it was
yeah.
an indication of long-term habit.
No, so
Okay.
it often has to do with, one, fee difference, and two, the hassle of how it's custodied or how it's transacted through. So if you were regularly needing cash flow and it was gonna be held at, many times a CIT will be custodied at State Street or US Bank. It's not one of the larger banking institutions where your actual pension assets are at Salem Trust. So if you had to go back and forth between this Winslow account and it was custodied somewhere else, you have to then get it wired. There's a day in transit for it to land. There's more aspects, administrative hassle. So sometimes having it in a separate account at your custodian, some simplicity from an audit standpoint and the like. Now, this particular CIT that we're talking about actually would be held in the custodial account, so that is not an issue. Any other questions, comments, discussion? Otherwise, I think we're out for the official vote.
Good.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Brendan Maresma,
Yes.
Jennifer Rutello,
Yes.
David Cohill,
Yes.
John Patrick,
Yes.
Matthew Brockie,
Yes.
Jason Sharp,
Yes.
George Canmore,
Yes.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yeah.
Okay, motion passes. So
Maybe?
just for general understanding, there's an application technically that we do, which is slightly different, so we'll get that application process underway. Once that's complete, then we actually do the formal instruction for the liquidation of the Allspring and then the purchase or the transfer into the.
Is there any benefit to engaging a transition manager for the termination of Allspring?
No, and the reason being, typically when you're doing transition, you're going from a portfolio of securities into another portfolio of securities, and you don't want to be, selling shares of Apple just to repurchase it once it lands in the other. But in a CIT, it's a little more cumbersome to try to move securities into that. So given that complexity, it's easier to liquidate the portfolio. And with being large cap, there's a lot less impact than what you say a small cap portfolio, more disruptive.
Okay. Do you recall what the number was we were at with Allspring?
Dollars? As of this morning, which I'm sure is what you were asking, 20,166,000. Up from 18.4 as of September 30th.
Too late.
So we're good to jump into the regular quarterly part of the presentation? Okay. So actually, did not print you a hard copy of this, but up on the screen, most of you have seen this before. It's just a update. It looks at the S&P 500 going back to the pre-GFC highs in 2007. And what you've got shaded in red or orange are any periods where the S&P dropped 5% or more. And obviously, what we're trying to illustrate here is certainly the power of investing over time is certainly markets move higher, even though you have a 55% drop here, you have a 13% drop here, you have a 33% drop there. You have these significant bumps along the road, but you stay invested and ultimately the market continues to move higher. The second part of that, and I think is really interesting, probably more interesting than the front. So that the chart on the front represents just over 17 years worth of trading history, okay? And over that period, the S&P averaged 10.02%. Of those 17 years, if you somehow could have been out of the market for just the 20 worst days, so a total of 4 weeks, that those markets had the worst handful of days, you would take your return up to 19.6%. If you somehow knew exactly how that was going to happen. Now, conversely, if you had the opposite in terms of bad luck, and you were out of the market market for the 20 best days out of 17 years. You take your 10%, 2%. Now, I only am familiar with one person that's been able to kind of consistently sort of avoid all those down markets. Their name is Bernie Madoff. In jet, you know. No one knows when those days are going to come, you know. And so the message that I would like to say, this is the beauty of the pension fund having a 50 to 100-year life. We're not trying to invest for a retirement tomorrow or next year. We have a long horizon, lots of participants, lots of beneficiaries. So we stay invested, we rebalance as necessary, and so you make sure you're in for all those good and bad days, and you get that 10%. You don't accidentally turn your 10% into 2% because you say, hey, tomorrow, we think tomorrow's going to be a bad day, so let's get out, and then it winds up, you know, being a good day, and you miss out. So now, go ahead and jump into the main part of the quarterly report. You've got the hard copy in front of you if that's easier to look through. I'm just going to hit a few pages really quickly. Page number 4. I'm just going to focus on the bottom right-hand corner of page number 4. This looks at the year that is our fiscal year end, September 30th. So in dark blue, you've got the S&P 500 was up 36.5%. Small cap stocks, as measured by the Russell 2000, were up 26.8%. The international stocks, depending on the benchmark, were up about 25%. And then in red, down at the bottom, the Bloomberg US Ag was up 11.6%. So if you think about, these are the main food groups, if you will, that we do our investing. And the worst performer was up 11.6%. So just as a general backdrop, this is going to be a pretty good year. Okay? I'm going to skip ahead to page number 10. No, I'm sorry, 11. Down in the bottom right-hand corner, this is the Treasury yield curve. So what this looks at is each yield level for all of the different Treasury securities from the 1 month all the way up to the 30-year. The blue line represents where we were at September 30th. And the other lines represent the prior 3 months, then the 3 months before that, and the 3 months before that. The yellow or orange line is where we were at June 30th. And what you'll notice is a significant decline on that page. So what we have is a significant drop in interest rates within the quarter. Now, part of that was the Fed actually cutting rates in September, but most of that move was actually even done ahead. That's the market kind of anticipating, one, that the Fed was going to cut, but also that inflation, although still elevated, is a lot lower than it had been, say, a year ago when we were over 9%. We're down closer to 3%, given the on any given month, and the year-over-year look. So inflation is coming down. Certainly, aspects of the economy are slowing, and so yields began to decline. Bond prices move opposite of interest rates. So I mentioned earlier the 11+% out of fixed income. This is why. You saw this big drop in interest rates, so your bond prices shot up in value as they did come down. Any questions on kind of general market commentary? If not, let's take you to page number 14. Can't go by this chart without reviewing it. This takes us back, we have your history going all the way back to 1987 when you were sitting at under $12 million. As a reminder, those blue bars along the bottom represent your net cash flow. So any money that comes into the plan, whether it be by active employees making their contributions, the city and or state funds, or the 175, 185 monies come in, minus everything that comes out in terms of expenses and benefit payments. So what you'll notice is, obviously, over that period, we've spent all of that $11.8 million plus an additional almost $39 million. So you're, I would argue, significantly cash flow negative, right? In terms of you're paying way more out than you're bringing in. However, your market value, at the end of September, $127.5 million. We also include that red line, which is the theoretical assumed rate of return. So if you just invested those assets and those cash flows into a theoretical investment that was earning your assumed rate of return, you'd be at $108.1 million. So you've outperformed your assumed rate of return collectively over that period, by roughly $19 million.
How's that assumption set?
That is set by the board. So on an annual basis, your actuary comes in to provide your valuation, and then along with that will be a recommendation if any adjustments are warranted or suggested, and then the boards make that decision. So we report on it, but it's just a reflection of what has been, approved, aside with the actuarial. And if I'm not mistaken, that would be your next meeting?
Or maybe.
May meeting, you'll have the valuation, which will essentially take the information from this book and memorialize that and put it into the next valuation, which then sets funding for the city and so on for, not to get too into it, but the funding period that begins on October 1st of 2025. So let's skip ahead to page 17. Yes. Sticking with the asset allocation, I like page 17 because it shows the deviation from our targets. Again, if the number is off to the right, it means we are overweight our target. If it's to the left, we're underweight. And generally speaking, we're relatively narrow in that range. We're about 3.1% over in domestic equity, 0.5% over in international, a little bit under in fixed income, both in domestic and global. But that, of course, is offset by the cash position. You see, we don't actually target cash, but we have about $1.8 million. So again, at taking the picture of September 30th, we actually look fairly good. There would be no need for rebalancing. As of today, instead of being 3.6% overweight equity, we're now at 5.25% overweight to equity, beyond the 65% threshold, which is the limit per the ordinance. So we might want to take at least a moderate action there, just to dial that back in, but we can kind of come back to that after we look at all the numbers, if that's okay. All right, one thing that I'm going to do just a little different is I'm going to actually take you, I'm going to work backwards in the report. So if you go to page number 23, I'm going to look at the different components and kind of work my way back up. So page 23, this is the one thing that actually went down in the year, real estate. We have the JP Morgan Strategic Property Fund was positive for the quarter, 82 basis points versus 0.13 for the index, but you'll notice the year, negative 10.5 versus negative 7.75 as they did underperform. Kind of the short version is they have more office within that portfolio than most of their peers within that index, which accounts for a good bit of underperformance. While I'm talking about JP Morgan, just recently, our research team, kind of similarly to the discussion we just had in Allspring, this goes back a number of months, is making the recommendation to clients in the Strategic Property Fund to move on. They have had some changes to their team. Additionally, they, like a lot of their peers that we track, there's about 15 of the Odyssey managers that we regularly track and interact with. Not surprisingly, over the last couple of years, most have said, we're going to try to minimize office. We're going to work, there are a lot of question marks and concerns, and so they have plans to kind of move away, minimize that exposure, and do other things. But JP Morgan really they've had these plans and haven't executed on them. They've kind of stayed where they are. So one, some changes in the team, and two, just not really following the plan that they've set out has led our team to say, I think there's probably better options within the real estate space. So we are recommending that you essentially put in for redemption from that fund, understanding that those markets are kind of locked up at the moment, so it will take a little while to get that money out of the portfolio or of the account. And so it's a long way of saying, typically I would come in and maybe come with ideas for where to put that money, but it's going to take multiple quarters to really start to get that money out, so we don't have to make that decision today. I would come back to you in subsequent meetings to review that. We didn't need to pile on at this particular point. I'm happy to stop and take questions on sort of that suggestion or recommendation as it relates to JP
I
Morgan.
mean, I think I asked in the May meeting, we've already been really far back in line, even back in May, for redemption.
Right, yeah, it is a very slow process now, not just for JP Morgan, but really all of their peers are what's known as an exit queue. And also to take it, you have to back up just a couple of years ago. In 2022, our equity and our fixed income portfolios were down double digits. Our real estate portfolio was up over 20%. And so what happened after the end of that year, we were overweight, you like almost everyone else, were overweight real estate because it was up while everything else was down. So a lot of folks put in for a redemption request, all the while interest rates are starting to hike up. And really the commercial real estate market's kind of ground to a halt. There's been very little transaction activity. So you can't just push a button and sell a building or what have you. So that's why these queues have gone up and they've been very slow to redeem funds. Now, many of those redemptions, if they were for rebalancing purposes, have been the release or partially released because equity markets are back up, real estate's down, and a lot of those positions have kind of right-sized themselves, as is the case for us. But with that said, those redemption queues are still in place because of the lack of liquidity within the portfolio. Now that we've seen 2 cuts from the Fed, there's some optimism that they're going to get back to a more liquid environment where transactions are occurring. So hopefully the pace of those redemptions speeds up, but we haven't seen that to date.
Now, when you put in for the redemption, is this recovered in all at once, or is it?
It's as they have liquidity.
Okay.
So theoretically, right, if they could push a button and get good prices for half the properties in the portfolio that they no longer wanted, and they were flush with cash enough to pay out all of the redemptions, then it could come all at once. Now, it's only done quarterly. So if you put it in now, I think you'd be in a position for like January, I think it's January 30th. So essentially, like, you put it in for the end of the quarter, the year, and then 30 days after that, I think is when they pay the actual make the distribution. My guess is that you put in a request for it, I forget the exact dollar amount, I think it's 5.2. My best guess is you get about $500,000 in January.
Sweet.
Unless the pace picks up between where it has been and ultimately when they make that distribution. Again, hopefully as we go through next year, maybe the next quarter after that is larger and larger and it moves through faster. But my guess is you still have at least some kind of position at the end of 2025.
Why would we hesitate to make that decision?
I mean, like I said, I brought it up in May, that I felt this was, and based on what you've been telling us, is this has been woefully underperforming compared to its peers.
Correct. It has struggled with office. I think that was part of the frustration is, plan that, hey, we know we're overweight office. We're going to be changing that. We're going to be shifting more to multifamily, to industrial. And then as we continue to watch it, it's not happening, which again becomes a sort of frustration though, and say, well, we've got all these other firms that have kind of set out a similar game plan to say, look, the dynamic in office has changed with COVID and everything else. So we're not going to sit here at 40%. And they go from 40 to 35 to 25% and strategically shift the portfolio. And one of the frustrations is JP Morgan, with a similar sounding plan, hasn't really been changing that allocation. And that's the bigger concern.
Well, I would have done it 6 months ago, but I mean, I make a motion to terminate, is it terminate or? Or redeem, much softer, the JP Morgan Strategic Property Fund. Now, my concern is if we, let's just say, do get the windfall of 5.2, I would expect at the next meeting, you have options for us to be able to move that in so we don't find ourselves completely out of balance.
I mean, I'll bring names next time, but the ultimate point I was saying is there's less time pressure as some other liquid investments where you say get out. You're not waiting 3 months or beyond to get out.
Now,
and make that transition.
is there there any concern with what we'd be getting into? Because we may only get $500,000, I'm pretty sure, no big bank wants our little measly $500,000. With the expectation that it would work up to that 5.2.
You're gonna get different answers from different firms, but they all understand the position, and I think there will be some flexibility to work with you.
Buy a couple Airbnbs in Jack's Beach. Is that an option?
Probably not in a
Would
budget.
you imagine for us?
No.
Or maybe just go straight in fixed, fixed, vehicle, or domestic fixed.
Certainly, I mean, in interim position.
Yeah.
Yeah, certainly, and again, we're a few months, if not quarters away from that, but just as an example, let's say, you know, we're $5 million is roughly the allocation. So if you recommitted to something else, and what I guessed was that they gave you 500,000, so your cash position goes to 2.3 million. And then the next firm, you know, 3 months later calls, they're probably not calling the entire amount. Maybe they call half. You have essentially that amount sitting in cash in it. So it could be a little bit of a kind of a give and take between the pacing of distributions and then the calling of new money to look at funding that. But that is a little bit of the challenge is trying to time, because you don't know exactly how quickly new money will go in, and you certainly don't know how quickly the old money's coming out. You'd love to be able to just tie those together, but.
Yeah, that's my concern.
Correct. Or alternatively, what you could do potentially is you say, okay, we've got $5 million coming out, but we're unsure of the timing, so we'll commit to $3 million on the new one first and see how it works out. And then 6 months later, 12 months later, after you have a little more information, you say, okay, now we have better clarity. Now we can add another $2 or $3 million to that commitment and kind of balance those out.
Cool.
All right, there's a motion on the table.
We gotta do this by board, don't we? Motion and second, all right. Roll call for Elise.
David Cohill,
Yes.
John Patrick,
Yes.
Matthew Grocki,
Yes.
Jason Sharp.
Yes.
Firefighters board, motion, second.
The motion was to call for redemption of our Morgan Stanley real estate fund.
JP Morgan.
JP Morgan, sorry.
Second.
George Canley,
Yes.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes. And I could make the motion to redeem the entire position for it was JP Morgan.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Brendan Marsma,
Yes.
Jennifer Ruto.
Yes.
Okay, so getting back to the report, I'm actually gonna go now up a page to page 22. Again, kind of going in reverse order. Now we're gonna get into fixed income, and what you'll notice is a lot of relative outperformance. So first is PIMCO Diversified. This is our global portfolio. For the year, they were up 15.4% versus 11.02 for their index. So not only did it outperform, but certainly had a very strong overall rate of return. Then above that, we have our two domestic fixed income managers. The Baird Short-Term Fund was up 8.1% versus 7.2, and then Sawgrass 11.9 versus 11.1. So again, relative outperformance in what was a very strong year. Again, when you think about that portfolio, we started the year earning about 5, maybe 5.25%. So you've got roughly double that rate of return because of those drop in rates, meaning the bonds were appreciating. Then as you move up to the top of page 22, we get into the 3 international strategies, all performed in the 20+% rate of return for the year, which again, in a normal year is a really nice return, but when you compare that to certainly the domestic stocks, they did underperform, although again, collectively, almost 24% out of that group of 3 managers for the year. Now if you move back to page 21, the last of the return pages, but again, I'm going to continue to go in this reverse order. Eaton Vance, that's our SMID or small and mid cap manager for the year, 30.01% versus 26.2%, so very nice relative performance, and again, a very strong year. JP Morgan, our value manager, almost 25%, but that benchmark was up over 27%. And again, that speaks to sort of that value defensiveness. When the market is up pretty big, they will tend to lag behind just a little bit, but still a very nice rate of return. Allspring, who we've been talking about, again, the last 12 months, almost 48%, beating the policy of 42.2%. So nice that sort of on the outgoing, you're getting some relative outperformance and a relative bump there, which is obviously nice. And then the last piece is our Vanguard Index Fund, 35.25% for the year versus 35.23, essentially tracking the index. I mean, outperforming actually just by a fraction. Then, take all of those numbers that we just talked about, go up to the top. For the quarter, not that that really matters, it's 6.31% versus 5.83, and you place number 11 in the universe. So you outperformed for the 3 months to finish the year. You outperformed 89% of public funds around the country. Most important number on the page is that second column, FYTD, fiscal year to date, and this is our year-end number. Gross of fees, 23.44%, placing in the 23rd percentile, better than more than 75% of public funds, and you beat your policy a little bit, which is like 23.24. Net of fees, after the expenses, 23.24%. Kind of net number we're talking about, Brad, your actuary, that's effectively what he's going to be using as part of that next valuation. I want to put just into a little bit of perspective here. In 2021, we had a total planned net return of about 19%. This 23.24% net is the best return in the last 25 years. Maybe you match that in the late 90s, but I even doubt it. This probably is your best return in easily within the last 40 years. So again, that's kind of what I want to sort of leave or close on is this fantastic performance within the report, because it is really a fantastic year. Let me stop there.
With cake or something.
Hey, we're gonna cupcakes later.
Well, I mean, I would think Brad would do that with the valuation, right? No such good news in there.
Brad doesn't strike me as a good cook. Just a better joke.
So then the only other item that I wanted to circle back with after kind of talking about where everything was, and again, I mentioned as of September 30th, we were at $127.5 million. Today, we're at $130.4 million. And that's when our fixed income has actually declined a little bit because interest rates have moved slightly higher in the last couple of months, and our equity portfolio has also gone up in value. So now we are beyond that 65% threshold, which is our ordinance maximum. So from a rebalancing kind of perspective, we're only over the 65 threshold by a few basis points. So we're not over dramatically. If we just wanted to get back under the 65, that would only take about $500,000, okay? To get all the way back to our target of 60% and give us a little more upside breathing room, that would be $6.6 million in total. And effectively, that would all come from domestic equity. With what's happened, we were fractionally overweight as of September 30th to international, with a larger overweight to domestic. Since then, international has actually come down, so we're at fractionally below target, and our domestic equity has gone up by quite a bit. As I mentioned earlier, the Allspring portfolio up almost 10% just in the last 2 months. So that's where the overweight has really risen or come from. If we wanted to only say take half of that overweight back, we're talking about $3.3 million. So again, in the past, we've not necessarily been comfortable going all the way back to target. We've sometimes taken some moderate steps. So that's why I want to throw out $3.3 million. That gets us to about 62.5% in equity, which is again halfway between our cap and our target.
Dustin, we expected any big backdrops or payouts.
One coming for fire. I
rebalance, you know, with everything we did today, to drop them off all spring and JP Morgan. Let's set the ground zero again.
For those that are inclined, that's, in the last 12 months, your equities are up 35%. So taking some of those chips off the table, if you will, after such a nice run, that's, you know, the way to look at it. And again, if you did that, you'd just be going back to target, not underweight.
Sure.
But just going back to target.
Now, I can safely assume that with the Fed looking at the last quarter, we can expect our domestic fix to not see double-digit returns.
Hopefully not. Yeah, I think expecting that kind of return again in that relative, in a short window is probably unlikely.
Okay.
But if the Fed does continue to cut, which is debated, you know, certainly GDP has remained elevated and there's some question about how much more they will cut. I would certainly expect those numbers to moderate, but even if you have a neutral interest rate environment, you're still collecting that, you know, 4.5%, 5% type yields off of those, at least the Sawgrass portfolio. The Bear portfolio is shorter in duration, so that will not quite yield at those sort of levels, but certainly a reasonable yield as compared to what we were getting 3-4 years ago.
But, I heard you say earlier, a lot of our returns were based on kind of.
On the drop in rates.
Correct.
Yes.
Where the stuff that we had bought was valued higher.
Correct. So in order to get another similar drop in rates and a similar kind of boost to performance, I think you need to see the economy really slow down. And again, that's why I say sort of, that's sort of the bad news. We've been able to get a nice drop in yields without sort of GDP and destruction of the economy. In order for another leg like that, I think you probably have to see a real deterioration in the economy, which probably then negatively affects the equity portfolios and other parts of the portfolio.
I wouldn't expect the Fed to do a whole lot in the next 50 days.
No, I was just kind of resetting expectations for
No.
the domestic fix.
Sure.
Quarter 1 and quarter 2 of next year.
What's the cap on international?
Are
we already there?
I mean, no, well, for police and fire, the max is 25% for international assets. Now that would combine with like the PIMCO fund.
Yeah.
But if we have a 10% target and sort of an intermediate kind of 5% cap of you know, so call it 15% is where we would sort of have the high side for the equity exposure.
Okay.
But we're underweight by 0.16, 0.16% international. So you're underweight a few dollars, but that's not, unless we were potentially trying to overweight the position, we would only get, you know, $100,000 or so to get it back to the 10% target. That would not be a significant source or, landing spot for the balance.
Now, I noticed Winslow in their presentation, they do have some international, I guess, exposure.
They're like kind of ADR securities or like multinationals that are domiciled outside.
I'm assuming that has got blended into the 25% threshold.
Correct.
Okay. So if we had in our allocation built in 15, I saw Winslow could get as high as that sort of 5% number.
Right.
We could essentially be bouncing pretty close on a big upswing on the international to that 25.
So that portfolio, the large growth, as it sits today, before any rebalancing, is a little over 15%.
Okay.
So if 15% of your portfolio had 5% in international, now you're talking about a fairly small number that you're then adding on top. So realistically, that is not a concern.
Okay.
If you were to set your international equity at 15, plus our PIMCO is another 5, getting to 20. Now all of a sudden, if those run a little bit, and you've got a Winslow that's buying in, now all of a sudden we're starting to get close, but we're a long way off where I would not be concerned.
Rogers. So let's go back. You said
6.6.
6.6 takes us back to our 60% target for total equity. 50% in domestic, 10% in international.
6.6 into what? Yeah, what
Domestic.
would you recommend it going to what, or
So,
into?
so the well, let's start with the three strategies coming out. It would come out of the, well, four, potentially. Vanguard, Total Stock Market Index. You've got the all-spring portfolio, soon to be Winslow, but let's just think of it as the large cap growth bucket,
Yeah.
right? The large growth bucket, we've got the JP Morgan Equity Income, and we also have the Eaton Vance SMID Cap portfolio. But realistically, the Eaton Vance, kind of within that subgroup, is really on target, so I would really just take it from the first three.
Okay.
They're all within the domestic equity. Of that, slightly larger than a third would be the all-spring portfolio. So what I would say is of the, of the 6.6, I would say take 3 million or slightly like 2.5 million from there. Then, no, I'm sorry, I said 3, I said 2.5. Sorry, I'm gonna take that back to 3. 3 million from Allspring. 2.5 from Vanguard. And 1.1 from JP Morgan.
And looking at rebalancing or sort of tactical opportunities, where would you recommend coming into?
We're, I kind of like splitting it between, and now again, if you have any other cash needs, you don't think we really have any. So I would tend to split between kind of domestic longer term fixed with Sawgrass as well as the Bear shorter term. A little bit more of the majority in Sawgrass.
So all back in domestic fixed?
I mean, all we really have are the, well, we've got domestic, we also do have the global, so PIMCO would also receive some of that. That's currently sitting 2% underweight.
Yeah.
So that would be, roughly $2.5 million.
Then nothing towards international?
You're essentially on target, so it could take, we could throw up $100,000, or so in there. But like you said, it's
Correct.
Yeah, and we could be seeing a tariff war early next year, and, it may well work out in the long run. It's a wonderful thing, but in the short term, it's going to be very, if it happens, very, very disruptive. So I'm not sure that it's probably going to hurt the rest of the world as much as it does us. So despite being a rating internationalist, I just assume we get the money at home.
So I'll just kind of throw some numbers out there to keep it sort of nice and even. We're talking about 3 million from the Allspring, 2.5 from Vanguard, and 1.1 from JP Morgan. Without that, then 3 million going to Sawgrass, 2.5 to PIMCO, and 1.1 to Baird. So I'm sort of addressing, again, not doing all of it longer duration, keeping some of it in that shorter duration Baird portfolio, but more of it obviously going to the Sawgrass, which is the higher yielding portfolio. And then obviously the balance back into PIMCO.
Works for me, that's why we hired you.
Well, I make a motion to sell, rebalance, what verb should I use?
I would use rebalance.
Rebalance, taking 2.5 million from the Vanguard Total Stock Market Index, 3 million from the Allspring or funds from termination, and then 1.1 million from the JP Morgan Equity Income, and purchasing or rebalancing to 1.1 million, the Baird Short-Term Bond Fund, 3 million to Sawgrass, and 2.5 million to the PIMCO Diversified Income.
Second.
David Cohill,
Yes.
John Patrick,
Yes.
Matthew Gocke,
Yes.
Jason Sharp.
Yes.
Firefighters, motion, second?
I can say I'll make the same motion.
I'll second it.
George Canler,
Yes.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
I make a motion that we rebalance the target, moving 2.5 from Vanguard, 3 million from large cap Allspring, and 1.1 from JP Equity, to 3 million Sawgrass, 2.5 million Pimco, and 1.1 million to Baird.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Brendan Maresma,
Yes.
Jennifer Rotolo.
Yes.
That is everything that I had for you, unless there are any other questions. Sorry, it was a lot, but it's nice to be able to take some of that money off the table after such a fantastic 12-month period.
I think it's a smart thing.
And again,
I don't know if this is a question for you or Dustin, but, what value is in having a securities monitor firm for potential litigation? In larger perspective of, I'll speak for me, my fiduciary duty, is there value in engaging with firms to at least monitor our portfolio for those potential litigation opportunities?
so it's an extra layer of someone that's looking out at the kind of the investment landscape or the legal landscape on your behalf. So kind of as it sits now, or if you didn't have any of those firms, then it would fall, it is sole folly on Salem Trust to kind of monitor what's happening and then, submit on your behalf. If there's a ExxonMobil, it's hard to pick on them, but, if there was some sort of legal action, a class action, then, and you were you an owner at the time that alleged thing took place, they would file on your behalf. So having a securities monitoring firm, they're out there, again, looking at the landscape, looking at cases, and they're also receiving, or they have your custodial data, so that they can also look to say, did you own security XYZ in this class period? And then, ultimately they give you a raise, this is the case, you need to make sure you're filing on their behalf or what have you. So there's no cost outlay to it.
Isn't Salem Trust more reactive when it comes to that than?
Like I said, they sound,
But
your
your
description
description
it
was
sounded
correct.
very passive.
Well, they're a custodial bank.
Yeah.
That's not, now, they're the one, they hold your asset in, again, ExxonMobil, to use the example. So when it comes time to actually file and be a participant in a class action suit, they're the ones that have to do it because they were holding the security for you. So they're the entity that kind of is the proof that you owned it and therefore you belong, right? But having a class action monitoring firm, that can help in the process, lessen the chance that something slips through the cracks, what have you. So it doesn't get Salem Trust out of the practice of having to file that claim or what have you, but it's somebody else that's looking at the process. Sometimes, depending on the size of your plan, they might come to you, if you've got a monitoring firm, they might say, well, hey, we've identified the situation, we would like you to consider being lead plaintiff and actually be sort of the named party that gets involved with depositions and the like. For a plan of your size, I think the chances of that is very, very low. More likely, they're just going to say, hey, you were part of this class when this thing happened, make sure you're filing it or make sure you're a partner.
So essentially, there's no real downside to it.
Again, I'm not an attorney, but from what I have seen, there's no real downside, there's no cost outlay. They're just working for a percentage of any settlement that happens, and that's determined by the court. So by having them or not having them doesn't change the fee that would be associated with that sort of service. There are a number of plans that have 3, 4, 5 monitoring. At some point, it becomes excessive. You'll have 3 different firms sending you a report all talking about the same case, and so it can become a bit, you know, burdensome or overwhelming to get too much. But having one or two, again, I don't really see a downside.
Does that fall under your umbrella or
It's
yours?
quite frankly more Pedro's department. Now, obviously, if there was a particular firm or whatever that you were interested in, but otherwise, what I would suggest is talking to Pedro and saying, hey, we have interest in one or two or three firms or what have you. What would you suggest? You know, because there are some nuanced differences, the type of law, the type of cases. So he might say, well, you might want a generalist and then a real securities or whatever. Perfect. That's getting into the legal side.
Can we put that on the agenda for, can you talk to them prior and put on the agenda for next month? Or
Bring it all
next
something
time?
next time, whatever I can find.
Okay, thank you very much.
There was one more thing on, kind of under your section, and it's just kind of a paperwork cleanup, from the assignment, from the movement from AMCO to Mariner, and just cleaning up our contracts for the purchasing policy and stuff like that. So before, Brent had just advised us that they were purchased by Mariner and everything, but there is an actual form in here for each board to approve, and then the chairman would sign it at the end. And again, it's just kind of to create a link between AMCO, because that's who our original contract was with, for the purchasing policy.
So you receive a motion from each board to accept this consent for assignment of investment advisory agreement?
Correct.
So moved. Second.
David Cohill,
Yes.
John Patrick,
Yes.
Matthew Brockie,
Yes.
Jason Sharp.
Yes.
Second.
George Cameron,
Yes.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
I make a motion to approve Mariner.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Brandon Maresma,
Yes.
Jennifer Rotella.
Thank you, and that's everything that I have, unless there are any other questions.
Thanks, Brent.
As a note, we still need to approve the quarterly report. We have not.
We're getting there. Oh,
His
yes,
report.
yeah, you're right. I'm sorry, thank you.
Motion to approve.
Oh, firefighter's going first. All right.
Second.
George Candler,
Yes.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
Motion.
Second.
David Cohill,
Yes.
John Patrick,
Yes.
Matthew Brockie,
Yes.
Jason Sharp.
Yes.
I move that we approve quarterly report.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Brandon Maresma,
Yes.
Jennifer Rotella.
Yes.
All right. On my pension administrator's report, this time I've got on the second page there, I've got the full kind of list for the year that's capturing the whole fiscal year of payouts. There are quite a few on the general employee side, and I know that, particularly the Sparrow Park, I took, try to clean up some of when people leave the city and they don't have to take their pension refunds when they leave. And so we have just a lot of these small ones sitting in there, these smaller balances, and just trying to contact those people and get them their money back so that, you know, they don't leave it here 15 years and forget it's here and then they can't find them because they moved 10 times and all this stuff. So it's kind of why you see so many on there for, you know, a good half of those are for those reasons. Coming up, we have the Winter Trustee School, which just opened for registration. I know I've got 5 already that are going to be attending, so that's pretty good. If anybody wants to attend and has don't expect this every time, we don't move money around, it's like nowhere near that much, this is probably the most since I've been here. And then the next thing is I provided loose leaf version of the, meeting calendar, so that's kind of the next thing on the agenda there that needs to be adopted. If, it seems like, I mean, we have good attendance here, this is the week of Thanksgiving, so that was kind of the only question I had, for next year was week of Thanksgiving, if you guys wanted to have it there or not. Problem is, the week before that, Brendan's very busy because people move their meetings from this week to that Thanksgiving week, so there is an opportunity we can move it 2 weeks forward to the second Tuesday if you guys wanted to make a motion to amend that date, or we could just accept this as is. We could also accept this as is and then change it at a later date.
I make a motion that we accept it as is.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Brendan Marisma,
Yes.
Jennifer Rutello.
Yes.
Need a motion to have the meetings at 25 is written here.
George Canley,
Yes.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
Motion, keep it as is. Second.
David Coho,
Yes.
John Patrick,
Yes.
Matthew Brocky,
Yes.
Jason Sharp.
Yes.
Okay, the general board, we're going to vote on approving application for retirement, Alicia Greenstein, accountant finance, effective November 1st, 2024, separation date October 21st, 2024, meets age and service requirements for normal retirement, 10 years, 0 months of service.
So moved.
Second.
Dan Jansen,
Yes.
Nick Curry,
Yes.
Brendan Marisma,
Yes.
Jennifer Rutello.
Yes.
Second approval will be application for deferred retirement, Kent Haynes, Technology Security Services Manager, Information Systems, effective December 1st, 2024. Separation date, July 12th, 2022, meets age and service requirements for deferred retirement, 10 years, 10 months of service.
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Brendan Marisma,
Yes.
Jennifer Rutello.
Yes.
On this one there, at the back of your book, it has each board and who's in each position currently, so there would need to be a motion from each board, as I understand it, to, for whoever, whatever position you want to, if you want to keep the same, or if you want to, that needs to be stated. To what position, I will just say that the police board doesn't currently have a chairperson pro tem because it was routine.
I'll make a motion to make David Coyle pro tem.
Second.
What's that, second?
Motion for David to take over pro tem.
Second.
We're going a little out of order, sorry.
I think we're still in the general board section.
Oh, okay.
Right now.
Go with it.
All right, well, let's start with the chair. I'm currently the chair. I'm happy to do it again, or you guys have a motion for somebody else?
I move that we keep Brandon Marisma as our chairperson.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Brendan Marisma,
Yes.
Jennifer Rutello.
Yes.
Now it's your turn,
We
Jason.
need a motion and second for the pro tem.
I do chairperson in that order.
I just see who
Okay.
it is.
Make a motion to keep Dan Jansen chair pro tem.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Brendan Marisma,
Yes.
Jennifer Rutello.
Yes.
Same for the secretary.
Secretary.
Nick Fury.
Motion to keep Nick Curry as the secretary.
So moved.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Brendan Marisma,
Yes.
Jennifer Rutello.
Yes.
Police, the chairman.
I'll make a motion to nominate Jason Sharp, continue as chairperson.
Second.
David Cohill,
Yes.
John Patrick,
Yes.
Matthew Grocki,
Yes.
Jason Sharp.
Yes. Make a motion to make David Cohill, pro tem.
Second.
David Cohill,
Yes.
John Patrick,
Yes.
Matthew Grocki,
Yes.
Jason Sharp.
Yes.
Make a motion to make the absent member, John Costello, the secretary.
Second.
Let him know, Brandon.
David Cohill,
Yes.
John Patrick,
Yes.
Matthew Grocki,
Yes.
Jason Sharp.
Yes.
Okay, firefighters, vote on your chair.
Well, since we're all here, we can't do the appoint the missing person thing. We thought we'd see if we could get away with nominating Candler as chairperson, Dawson as chair pro tem, and White as secretary, all in one motion.
Second that.
So moved, yes. So moved.
George Candler,
Yes.
Ed Dawson,
Yes.
Sean McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
Love it. All right, the firefighters are going to approve application for backdrop retirement, David Rice, fire engineer, effective November 1st, 2021, separation date October 11th, 2024, meets age, service requirements for backdrop retirement, 23 years, 2 months of service.
So moved as read.
Second?
George Candler,
Yes.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes. Yeah, that goes along.
Any other discussions for today?
That was our first firefighter retiree since the firefighter.
No, it's been a long time.
5 years.
Oh, yeah.
The first one.
Did you retire, he didn't have to sleep all day?